Hello, chart watchers, and welcome to this Thursday, February 21st, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got a little bit of downside action in the market today. We got the Dow Jones Industrial Average currently down 61 points. It was down a little bit more than that earlier. The S&P 500 down 6 2/3. The NASDAQ down 18 points, and the Russell 2000 coming down off of its serious winning streak of late, down 5 3/4 points. 10-year Treasury yield trying to get back through that 20-day moving average. It is up 3.5 basis points today, 2.69%. This is where it has been struggling, though, so we'll see whether or not we can get through. Volatility index is up a little bit today, which makes sense with a little sell-off in the market, but still down at 14.43, which is quite a bit lower than what we've seen over the past few months. Leading to the downside today is healthcare. Biotech's having a particularly rough day. And you can see the market overall going higher here over the past 4 weeks or so. And biotechs really have not been able to make any ground to the upside. So we're seeing a lot of relative weakness in the biotech group of late, and that is showing again today. Leading to the upside on the S&P 500 is Albemarle Corp. This is a company that's been under pressure for many months, starting to show more strength, and it did beat in their estimates, I believe, raised guidance. We'll talk about that in just a bit. Microsoft making a breakout above recent highs. So Microsoft performing very well in the Dow. Two stocks not doing well in the Dow, though, today. The two top losers, Dow DuPont, which actually got close to resistance after it had come out with some disappointing results recently. And it is turning back lower. And then something I thought was kind of interesting, Nike down 1.4%. I don't think I've ever seen a company or a stock market impacted by a basketball game. But last night, Zion Williamson, star freshman from Duke University, blew out through like one of his shoes or something. His foot went through his shoe, and Nike asked for the shoe to come back. And they wanted to take a look at it. And so anyway, I don't know if that's why the stock is down, but clearly the stock down 1.4% today. It was quite a sight. I'd never seen anything quite like it on the basketball court. And I know you're not a huge basketball fan, Erin, but I don't know if you'd heard about that story last night.
I heard some chatter going around about Nike, but I wasn't sure what it was. I was busy watching hockey, of course.
Yeah, well, it's always interesting, when I see a pattern develop on a chart, and I'm going to look at Nike in just a few minutes. It's got off of a long-term uptrend. There's a big cup, and it's starting to fall back into a handle. Now, I'm not a conspiracy theorist. I'm not saying that somebody plotted this shoe to explode, but it is kind of interesting from a technical perspective. The stock could use a little bit of a pullback, and we got the exploding shoe to help in that process. Anyway, I thought it was kind of funny. I want to bring Julius in because, he's always a great guest on here, Market Watchers Live. And Julius, I know you're overseas in the Netherlands, Amsterdam. Do you follow basketball here in the U.S.?
Well, not really, but this story I picked up because it was all over the news. So you could be right.
Did you see the play?
No, I didn't see the play. I saw a picture of the guy sitting on the ground with his shoe off. So it was quite funny. So yeah, well, it made its way across the ocean.
Yeah, for those of you who are not familiar with college basketball and Zion Williamson in particular, this guy is 6'7", 285 pounds. He could stand next to LeBron James and make him look a little bit small in the paint. I mean, this guy is the most amazing athlete I think I've ever seen. And as a freshman, and we're talking about an 18-year-old kid. And anyway, I mean, I think I could probably put both my feet in his shoe. I'm pretty sure. And it probably still wouldn't explode. But anyway, I just had to point that out. I'm sorry. I found it to be a very funny story. And like I said, I've just never seen a basketball game impact the stock market. But there is a lot of talk about this shoe and the fact that I guess maybe it wasn't constructed well. I mean, I don't know.
That's crazy.
It is crazy. And but I tend to be crazy sometimes. I'm going to let you get into this, Erin. We got a busy schedule.
Yes, we've got business to do here. All right, next week I'm going to be doing a workshop. I'm actually going to call it Relatively Speaking. So we'll be talking about price relative and how the various sectors are doing, etc. And then on Wednesday, Tim Ord of the Ord Oracle, a fellow market timer of mine, will be here on Wednesday, followed by our March seasonality report by Tom. So a great schedule coming up next week. But what are we doing today? Well, we're going to start off after the technical news with breaking it down, but we're going to do that with RRG with Julius today. So that should be really interesting. And then 10 and 10, our first symbol will be Auto Home, ATHM. And finally, we're going to finish with stocks on the move. So the stocks we're seeing that are breaking out and are interesting, we will present them to you. All right, Tom, let's go ahead and get started with the technical news, except for Nike and headlines.
Sounds good. Let's go into the economic news today. There were a bunch of reports out this morning. You can see those on your screen. December durable goods came in better than expected, although if we strip out transports, there was a slight miss. Initial jobless claims came in better than expected. We've seen those on the rise lately, so that was a good thing for the market. Philadelphia Fed survey for February, though, came in negative territory, minus 4.1 versus the positive 14 expected. So that was a slight disappointment there. February PMI composite flash, better than expected. Existing home sales, slightly below expectations. And then finally, leading indicators for January came in with a minus 0.1% versus the positive 0.1% that was expected. So a lot of mixed news there. We take a look at what's going on in the Treasury market. And I'm kind of watching. I'm still not overly excited about this long downtrend that has been in play here with the 10-year Treasury yield. I do want to see this break out to the upside. If you're a proponent of a stronger U.S. economy in 2014, well, you need the 10-year Treasury yield to start rising, because that will rise in anticipation of economic strength. Haven't been seeing that. You can see throughout the last 3 or 4 months, every time we've gotten close to this 20-day moving average, we've either gotten through it temporarily, not been able to sustain it, or we simply haven't been able to get through it. Today, we are right on the cusp of it again, 2.69. 20-day is sitting at 2.686. And, of course, a breakout would signal Treasury yields rising, which means Treasury prices dropping, and those proceeds typically make their way over into the stock market. So there's two things that really fuel equity prices. One is obviously new money coming into the stock market, and two is the rotation from other asset classes like treasuries into the stock market. So this is something that we talk about it every day, and we should, because this is an important component of what we could see in the U.S. stock market. All right, let's take a look at the earnings reports. And again, there's still a ton of those coming out. There was a big disappointment last night from NetEase, $2.66 versus $2.69. They also missed on their top line as well. So a couple of pieces of bad news there. They came in at, their revenues were $2.89 billion versus $2.91 billion. So miss on both top and bottom line. Agilent, though, did come in strong. You can see your earnings per share there. They beat on their top line. They guided fiscal year 19 slightly higher. Realty income has been a great performer within the real estate area. You can see strong numbers there on their bottom line. And then right down the line, some pretty good results. After the bell today, Baidu, Intuit, Kraft, SBA Communications, Consolidated Edison, blah, blah, blah. We got a lot of stocks still coming out later today, and the earnings floodgate still open. All right, let's take a look at some of these stocks. I'm going to start off with NetEase. All right, NetEase. And, when you look at the chart on NetEase, it really has struggled to break out, which is generally not a good sign. I mean, look back where the stock market bottomed on December 24th. Actually, maybe it was December 26th, I think, intraday. And look at where we are on NetEase. NetEase has not participated in this move to the upside in the market. So you can imagine when we go to a relative chart and we compare NetEase to the S&P 500, it is quickly deteriorating, and we're not too far from a 52-week relative low on NetEase versus the S&P. Now, the group is also turning down. This is the internet space relative to the S&P. So that group, which had been under pressure in the second half of 2018, looks like it's starting again. We want to watch a couple of these relative lows. If they're lost, then I would suspect we're going to go back down and at least get a retest of that November relative low. But, all of these charts, with the exception of the absolute performance in internet stocks, which obviously just about everything has been going up. Rising tide lifts all boats. Internet's been going up. It's just not been going up as fast as the overall market. And you can see NetEase is not going up as fast as the internet group. It's not going up at all. So with these numbers, and again, when you get a report like this where you've got a missed top line and a missed bottom line, these technicals should not go unnoticed. This is a company that, in my opinion, was not acting like we were going to have a great report. So I think we're just simply getting the news fundamentally that we've already seen based on what's been going on in the charts. Move on. Let's go to Agilent. Agilent Technology. Big breakout here prior to their earnings report. Even though Medical Equipment Group has not been going higher, Agilent had broken out. So you can see the relative strength here. You can see the relative strength versus the S&P, and you can see the relative strength in the Medical Equipment Group. So again, the technicals have been telling us good news is around the corner. Today we get it. They beat on their top line, 1.28 billion versus 1.27. Beat on the bottom line, as I showed, and they also guided slightly higher. Stock was down earlier a little bit, but still above its rising 20-day moving average. I think Agilent still looks very good on its chart. Realty, O, ticker symbol O, that's an easy one to remember. They did come out with strong numbers. They guided in line, saw a little bit of selling at the open, but you can see the stock rebounding right back off that 20-day moving average. I think looks good. Synopsys, SNPS, beat top line, beat bottom line, gapped up. So far, though, with reversing candle, I like this one's got mixed signals to me because we're at a major resistance area, possibly reversing candle, but on the selling, we held the rising 20-day moving average. So I think overall, this is a pretty good stock, and it's in a great sector. Yes, the software group, you can see, has been performing well off the December low. This stock is starting to show strength relative to the software group, broken out relative to the S&P, and here you can see software just continuing to outperform the S&P 500. So all in all, if I had to err on one side or the other with Synopsys, it would be on the long side. Let's take a look at one more. NEM. This is Newmont Mining. Big breakout here yesterday prior to earnings. Earnings were pretty good here. They beat on the top line, easy beat on the bottom line, 40 cents versus 23. Things looking pretty good. The overall group has been gaining strength on an absolute basis. I'm still concerned, though, longer term. You look at a stock like Newmont Mining, it's been underperforming its peers. You look long term, at best, I mean, over the last year, at best, it's been kind of going along for the ride with the S&P 500, but it almost looks to me like a little bit of a topping pattern here. And then the group relative to the S&P is topped based on that. Well, back at that December low, the money is rotating during this rally away from the mining stocks. So anyhow, some things to think about. Now, I wanted to mention a couple of things. I talked earlier about Microsoft breaking out. Update here. Microsoft has the largest market cap now, $837 billion as of about 40 minutes ago. Apple, $806 billion. Amazon, $792, and Google, $765. So Microsoft making a breakout here, but also leading the other stocks in terms of its market cap. A couple of others I mentioned. Let's take a look at that Nike chart. Nike here came up right up against this resistance. Now, this might look like it's a pretty deep cup, maybe too deep. But if you look at the longer-term weekly chart, you can see a huge rally. This is a nice little cup here. And short-term weakness here could produce a handle, which would be very bullish on Nike. DWDP, and I'm going to go into a relative chart here. This is a stock that just has not been performing well. Notice the gap down on heavy volume. Buying intraday failed at about $57. Today we got to 58 or 56.82 before reversing off this uptrend. I don't like that candle. I think we could be looking at Dow DuPont moving lower. All right, Erin, upgrades, downgrades. What do you have for today?
All right, let's get started. It was another interesting day of just a handful of upgrades and a load of downgrades. So let's go ahead. We're going to take a quick peek right now at some of those that we had. Let's see here. I had that up and now it's gone. There it is. Come back here. My bad. I hit the wrong button and I ended up getting rid of all of them. There we go. So that's where I get those upgrades and downgrades, but we're going to look at the chart list right now. So the first one I'm going to talk about, though, is Sam Adams. This one was upgraded today by Macquarie from an underperform into a neutral. So I thought this one was interesting. I suspect there was earnings. I was going to look that one up, but there was something that went on today because I can't imagine that an upgrade would give you a 13+% rise. So, but at this point, I noticed this gap over here, and that right now we're hitting right up against that. Now, of course, that gap was closed, but it's always interesting when you find support and resistance right around there. And I was looking for what the next resistance level would be, and I noticed that that gap really is about where we've stopped right now in this incredible move. I would expect to see a pullback for sure. This one would be one you wouldn't want to chase, but you do see that the 20 and 50, the 20, 50-day EMAs have crossed over. So that's an intermediate term trend model buy. And the 50 and the 200 look like we're going to get that positive crossover there, and that would put us in a bull market configuration. But I have to say, overall, I mean, look at this stock. It's been in a trading range between 260 and 330, and we're already at about 304. I don't think there's a lot of upside potential here, even on that upgrade, unless we get a really sizable pullback.
Yeah, just to give you the information there, the news, they did beat on their top and bottom line earlier today.
Okay, that would be the reason then. All right. Okay, so the next one we're going to look at is U.S. Steel, and I know this one's been popular in our 10 and 10. Berenberg has upgraded this from a hold to a buy. I think that's an interesting call. I think you could certainly make that with looking at the way the PMO is working right now. It's really at levels we have not seen this year since, well, back in March of last year. So seeing some good momentum there with the PMO, you can see that volume is tracking with it. You know, to see a nice bit of volume here. The only issue I have is that because the OBV, you see that top back here on this top we had, and the top that is, well, the top we had back here, you can see that we came really close to actually maybe even beating that top. So what does that tell us? That tells us that we've had all of this increase in volume since that top, but we haven't been able to move price back up to that top. And so that tells you there could be a little bit of weakness under the hood there that maybe isn't as obvious. And of course, I think the scooter is telling us the same. But if we can get the breakout above this resistance level where we have that low back in October, I would, and this declining tops trend line, then I would be looking at this a little more seriously. We do have the 20-50-day EMA positive crossover, and that is an intermediate term buy signal. All right, let's look at a few of the downgrades. All right, Avalon Bay was downgraded today, and I have to say, good call on that. You can see the PMO has reached overbought territory. It's turned over as we've topped here, and it looks like it's ready for a sell signal. I would not expect it to hold this support level at the top we saw back here in December. I would expect it to come down and at a minimum test that rising bottoms trend line, because I would be looking for this rising trend right here to be broken, just based on our momentum signals here. All right, next one up on the downgrade, and I have to say Lennar was also downgraded today, but we're going to look at the DR Horton chart right now. As you can see, PMO, it does appear to be overbought, but really you can see it goes down to the -4 area. So really in this case, the range is -4 to +4. So the PMO technically isn't that overbought. But you know what? We had trouble at this area of resistance at $41, which had been previous support back in September, and we fell back. At this point, if we can hold $39, you can see that that adds up back here to those lows from May through July. Basically, if we can hold that, you know, maybe we could get back up to a rise. But the fact the PMO is decelerating and, you know, we're not seeing the kind of movement we'd want to see out of it, I would expect it to break down here. So I think the downgrade was probably a good call. General Mills was downgraded by Standpoint Research from a buy to a hold. Now remember, some of these downgrades were, in fact, all of them today are moving to neutral or hold. We're not getting any sells on these downgrades, so just wanted to mention that. All right, I actually like this chart if we get the breakout. Right now, I would like to see that $47 level, be broken, and especially this gap to be closed. In this case, we've gone since March of last year without being able to close that gap. Even with the difficulties we've had here, it's a consumer staple. I would have expected it to perform a lot better. But right now, it's definitely looking better. It's not overbought. It's overbought in its bear market or in its trading range, but not if we're going to break out. And I think this one, considering the fact that it's downgraded, I wouldn't agree. If you get that breakout with this PMO looking the way it is and volume is behind this move right now, I would expect to see the breakout and a move higher. So I don't actually agree with that. And then Tom, I know you talked about NetEase. It was actually downgraded today as well by Jefferies from a buy to a hold. Like you, don't like the chart. We've got this rounded top going on here. Look at in the thumbnail, 20, 50-day EMA negative crossover below the 50-day EMA. So that is an intermediate term trend model sell signal. And as you can see, the 50 came all the way up here to the 200, was unable to give us that long-term trend model buy. And so here you go. Now we've got the decline and we're breaking down below some very important support at 220. So I would expect it to move lower. And I think that downgrade was called for. So let's take a quick peek and then I'm going to hand it over to Julius. These were the upgrades and downgrades that I didn't go over. I won't read them all out to you, but I thought interesting on the downgrades was Biogen, Garmin, and Lennar. Like I said, Valero also downgraded today. All right, Julius, time to come in and talk RRG. Well, Julius,
unmute myself. That helps a lot. I was already sharing my screen and talking to you all, but that didn't work. So here you go. This should be visible now.
Yes.
Yeah, we've called the segment breaking it down with RRG. But before we dive into that, by the way, we're going to talk about the technology sector. We're going to try to break down the technology sector, and Tom will be my sidekick, or I'll be Tom's sidekick probably. But before I dive into that, sometimes I got questions from readers and watchers of the program, and one of the questions that I got recently have to do with using the $1 benchmark for RRG. And as you know or may know, usually an RRG takes a benchmark that moves. Like, if you look at the sectors, we use SPY as the benchmark, and SPY itself can move up or down. Or if we look at, let's say, the technology sector, we use XLK as the benchmark, and we look at all the individual stocks against XLK. What we can do is a little trick. We can use $1 as the benchmark for RRG. What that actually does is it makes RRG more of an absolute type of tool. Maybe the best way to show it is to bring up an RRG of, let's say, the Dow 30 industrial stocks. So this RRG holds the stocks inside the Dow Jones Industrials, and as you can see, it's pretty spread out evenly across the canvas. And if I change the benchmark to $1, and $1 is a line that's always one. If we bring that up, you will see here in the side chart that this is just always one. So we're pretty much comparing all these stocks against one. So it becomes an absolute tool. What you will also see is that the characteristics of the RRG have changed, because now all these stocks are chasing each other through all the quadrants. When the market goes up and down, all these stocks move at the same time. You can still see some relative movement, so you can see that BA is leading right now, and Nike, despite the shoe. By the way, this is a weekly trend, so looking at longer term trends. INTC are the stocks that are leading the market higher, and Apple, not surprisingly, is a laggard and just is like WBA. One of the remarks that I caught was, should not every retail investor use $1 as the benchmark for RRG? And that relates to the fact that when you use RRG as you would normally use with the relative benchmark, in this case Dow Jones Industrials, it is very well possible that stocks show up inside the leading quadrant while they are dropping in price. And the only reason why they show up in the leading quadrant is because they are dropping in price less fast than the benchmark. So you're still outperforming. That's the story of a fund manager who loses 5% of the money in his fund, but the benchmark lost 10%, so he's outperforming 5%, so he's a star. You can have a lot of arguments about that, whether retail investors should or should not use $1 as a benchmark. I'd like to look at this from a bigger perspective, and let me put it like this: if you as a retail investor are only investing in the stock market, and you're either 100% long or 100% cash, then yes, it makes sense to use $1 as the benchmark. However, if you're a prudent investor, or you're a registered investment advisor, or you work with an investment advisor, you probably run a portfolio which doesn't consist of 100% in stocks, because that'll be very, very risky. So you probably have some holdings in treasuries and bonds, maybe some corporate bonds, maybe some commodities. So you have some sort of an asset allocation. Now, if your asset allocation tells you to be underweighted in stocks, so instead of, 60% in stocks, you're now only 20 or 30% in stocks, it means that you still have some sort of a holding in stocks. And then it makes sense to look at stocks relative to a benchmark, because although you're not so happy with the performance of the stock market, your asset allocation dictates that you should have at least a small portion in stocks. So you need to know which ones are the best ones. So then also retail investors, I think, should use the relative benchmark like SPY or Dow Jones Industrials, et cetera, et cetera. And it brings me to the third point on this sheet, and that's that I believe that what we most of the time do here in the show is analyzing markets and making calls on stocks or sectors or industries, saying, yeah, we believe it's going up, or we believe it's going down, or it's breaking, et cetera, et cetera. That exercise, that analysis of markets, making up your mind, building a picture of the market, is, in my mind, completely separate from what I would call portfolio construction and portfolio monitoring. Because if you say, hey, we think Apple is going down or up, it says nothing about how much of your portfolio you want to invest in Apple. Or if we feel that the stock market is going down, if you have a proper asset allocation tool, are we going to go to zero holdings in equities, or are we going to 10% or 20%? And of that 10% or 20%, how much is going to be in technology and in staples and in utilities? That's the process of money management or portfolio construction. And these are very, very different and very, very separate from looking at a market and making up your mind whether it's going up or down or outperforming or underperforming. So that's that. I just want to, it's answering the question that I got and highlighting the fact that there are multiple forces at work, also for retail investors, where you should think about what your asset allocation looks like, what is your risk profile, how much equities can you afford. If you're, 60, 65 years old and you're close to retiring, you probably don't want to have a portfolio that's 100% in equities, because you don't have the time to sit through a big market decline. If you're 25, 30, you got plenty of time. You pretty much always want to have some form of equity holdings in your portfolio, because you got plenty of time to recover from setbacks. That's the whole thing about asset allocation. Okay, so let's not waste too much time on this, but I think it's interesting, and it's something that people probably should pay attention to more than they actually do. Now, breaking it down, and I discussed with Tom. Tom started doing that in his blogs, which I read every day, because It's 5 to 10 minutes well spent. You're up to speed what's going on in the markets. If you're not subscribing to that blog yet, please do it. It's one of my first go-tos in the market, and then I'll see what my own opinion does. But it's a very quick way of getting up to speed with what's going on in the market. And he started using RRGs a lot more recently. Thank you for that, Tom. Much appreciated. It got a lot more eyeballs on RRGs. And he's using it to break down the market, breaking it down. And that's exactly how I started working with RRGs almost 10 years ago now. Because you start from a top-down view, you make up your mind. You can do it for asset allocation, then you go to the sectors, then you go to the industries in the sectors, and then you can actually go all the way down to individual stocks. And what we want to do in the segment today is to zoom in on the technology sector. Now, let me quickly bring up because we talked about asset allocation, and I want to highlight the fact that we actually have a predefined group on the RRG page for asset allocation. And this is the current picture here. The asset classes that we're looking at are investment-grade corporate bonds. We've got treasuries. We got the US dollar index. That's primarily to make up a gauge against foreign stocks. High-yield corporates, real estate, commodities, and of course, SPY, the equity market. On this longer-term picture here, this is a weekly picture. We see that SPY is still way to the left, and bonds are still way to the right. That's the rotation that we saw where, oops, no, don't do that. Don't do that to me. That's the location. Here you go. Where we had that rotation going back and bonds started to take over from equities. About here, you see SPY rolling over, and you see IEF Treasury here heading towards the leading quadrant and basically leading that universe all the way down. Now, we're in this recovery here out of that low, and although IEF is still to the right, it's losing momentum, and SPY is picking up momentum, clearly because the rally in the stock market right now. From a longer term perspective, bonds are still preferred over equities. I don't know whether that rotation is going to continue. Maybe SPY is going there, but for the time being, I'm still very cautious about stocks in general and being heavily overweight the stock market versus the rest of the universe. You see on the dailies that IEF is gaining here and SPY is in weakening after having spent a move through leading. So it's coming down on the dailies and it's now very static. So I'm very curious to see whether SPY and IEF on the daily will continue to rotate on the right or on the left-hand side and drag that weekly rotation in favor of equities, or that the weekly rotation is leading and that we will see SPY, difficult to say here because the tail is so short, will continue that way and IEF will continue that way. My last blog on the RRG blog this week highlights this and also the fact that there is a big disconnect in sectors where you see all the defensive sectors on the right and the more aggressive sectors, offensive sectors on the left and moving higher. And that's the next RRG that I want to bring up. And then we're going to zoom in on XLK, as I said. This is the weekly version of the RRG for sectors. And you see utilities, staples, healthcare, real estate. They're all on the right-hand side. They're typically defensive sectors. They're strong long-term because on the right-hand side, but they're losing momentum. And we have XLK, we got financials, got industrials, communication services making this rather strange hook, and we got discretionary, the only one inside leading, but already rolling over. So for me, there is a big disconnect. There's nothing in lagging. There's only one in leading, and only barely. There's a bunch in improving and a bunch in weakening. And I wouldn't be able to tell you whether these are going to be pulled higher and rotate on the right-hand side, or these stay on the left and continue to rotate on the left-hand side, or they'll be pulled into leading. So we got a lot of mixed signals. That even becomes, I would say, much worse when we move to the weekly version of this chart, where we see that staples and utilities are now close to or already inside leading, and we see technology, industrials, and real estate losing again. So again, pretty much the opposite of what we're seeing on the weekly, which is, for me, it's not confirming, it's sending mixed signals, which makes me a little bit worried about what's going on in the market as a whole. And for that, I want to bring up the blog that I wrote, or actually today. It's the DITC blog, in which I highlighted one of the things that caught my eye basically when I was looking at markets, and that's the volume pattern. And if you look at the SPY, volume needs to confirm price. And what we see here is that in the past few declines, volume was rising, it's flat, and the decline is rising. And all of this rally is showing a declining volume. And I don't want to spend too much time on it, but it caught my eye. It doesn't match with the Dow theory that says volume must confirm the trend. But before the show started, I had a discussion with Tom on volumes, and he pointed out, because he's some sort of a walking encyclopedia of data, that volume is pretty much always light when new rallies start. So we're going to see. We're going to see what happens. But I'm not totally convinced. That's why I'm missing out on this rally. I'm overweight defensive still, but I'm still in the equities market. So to come back to the $1, I'm still in equities because my asset allocation tells me to still be in equities, but I'm underweight. I'm in defensive. So I'm lagging the rally, but I'm not completely missing out. Okay, technology. We saw the picture of technology on the RRG on the left, and improving on the weekly, rolling over on the daily. And then the next thing we can do is break down technology into the industries. And that's a predefined group on stock charts as well. If you go to the sector summary page, you can look at the sectors, and there is an RRG symbol to the right. If you click on that RRG symbol, it'll bring up this chart that'll show you the industries that make up the technology sector. And if we look at, this is computer hardware all the way on the left, pretty much dominated by Apple. And because Apple is so big, we see that a lot of stuff has to be on the right-hand side to balance this universe out. So computer hardware far away to the left, and then all the other ones are on the right, but closer to the center of the chart. The ones that we like is semiconductors. It's on the right. It's lowering a little bit, but it's not completely rolling over. It's just gradually moving to the right. Stable, very good. Computer services is just crossing over, gaining on the RS ratio axis. And the one that also stands out is software, not because of its heading, but because of the fact that this is the strongest industry in this sector, all the way to the right. If you measure it only on RS ratio, it's all the way to the right. It's losing a little bit of momentum, but if we play the history, you will see that it continued to rotate on the right-hand side. So every time it loses a little bit of momentum, and then it goes back up. And because it's the strongest one, there is still plenty of time and opportunity for software to rotate back higher. So these are the three groups that really stand out here. And then the next step would be to go to the individual stocks that make up that technology sector or make up those groups. And we can actually bring those down from a group here as well. So these are predefined groups. All these groups hold the top 50 names of that sector. I got to be careful here, because sometimes you'll be missing some stocks and you think, oh, but this one is in that sector. Yes, but then it's probably a smaller one and it dropped off. If it's a large sector, because the number of securities on the RRG plot is capped at 50 for good reasons. You can see here that this holds 50 names. It's already getting pretty crowded. Now, a good way to browse through these crowded universes is to actually select the line in the table. And what you can then do is on the Windows machine, you hold down Control and you press the down arrow, and you can toggle through all these individual names. And on a Mac machine, it's the Command key and your arrow keys. And that'll, I find that a very easy way to browse through the various names on a crowded plot to look at the rotation, because I still have the relative picture. I still have all these other names in that universe on my screen, and I can look at them. We don't have a ton of time, but let me pick out what I did. Is I did this exercise prior to the show, so I browsed through a number of these stocks, and what I then did is I created a separate RRG that held or holds the ticker symbols that I thought were interesting enough to discuss on the show, and that's what you see here. So this is a subset of that technology universe, which makes it easier to read. Now, let's work our way, because in the poll we have a number of these stocks. So let's work our way through the names that are in the poll, and then see if there is any time left. We can work a few of the other names. And one that came up is Vmware. Now, Vmware is on the right over there. Let me put that here on the chart. By the way, this is my favorite setup, where I have an RRG on the left-hand side of my screen and a price chart on the right-hand side of the screen, and I can simply jump back and forth between the RRG and the price chart and see everything I need to see. Now, Vmware, as you can see way to the right, losing momentum, losing relative momentum, but this relative strength chart is very, very strong. This price chart is super strong. It's it's all the way up. Maybe we're getting, like, I bet, I haven't looked even at it, but if I bring up an RSI or stochastics or any overbought, oversold indicator, it'll be very, very high because of the recent rise. Makes it probably a little bit vulnerable to some profit taking short term. But in case of any declines, I think this will make a great buy, because it's on the right-hand side. It's one of the strongest stocks in the sector, in a stronger group. And this relative strength line is just awesome. RS ratio at very high levels. This could come off a little bit, rotate, and then momentum picks up, and you got a good new buying opportunity.
Hey, Julius.
Tom, yeah, I was going to say, when you want to jump in, just feel free.
Yeah. Well, first of all, I just want to clarify one thing you said earlier. I am definitely your sidekick, not the other way around. No doubt there. I think it might be helpful, too, to point out on the right chart there, the readings on the relative strength ratio and relative strength momentum and how they correlate to where VMware is on the chart. For instance, that red line on the right-hand side is your relative strength ratio. And if folks look at that, they can see it's up around 115 or so.
Yeah, so that's like right here.
Yeah. Yep.
So yeah, good point. The red line is the ratio, which is the horizontal axis on the RRG. The green line is the RS momentum, which is the vertical axis. So if we look at VMware, it's, let's say, 115.98, so 116 and 103. So we got 116 and 103 is probably right in the middle between 02 and 04. So that's where you position VMware, and that's how you can basically bring back what you see on an RRG to a regular chart. And what you see is it's the uptrend in relative strength that we're measuring. That's why that RS ratio is going higher. And that dip in RS momentum is because this acceleration, so to say, of this move, the rate of change of this move is leveling off a little bit. And that's magnified here by the RS momentum. And that's how you see the tail going down and the stock rolling over on the RRG chart.
And I think, too, the power of this, in my view, is when you see both of those lines at the 100 level and starting to turn higher, many times that's right before a huge move in the stock.
Yeah, you're right. When they start to move in sync, that's really strong. And while we're talking about theory, when these lines move in sync higher, so they're gaining on both axes, it means that the what we call RRG heading is between 0 and 90 degrees. So if you look at a compass, 0 is due north, 90 degrees is due east. Anything in between, so in this area, is positive. Mind you, it doesn't necessarily need to be in the leading quadrant, because here for WDC, MU, and SWKS, these all have headings between 0 and 90 degrees, because it measures from the previous observation to the current observation. So for WDC, previous observation, current observation, that's a heading probably 35, 40%. MU is probably around 40%. SWKS is more north than east, so that's probably 15, 20%, or degrees, I should say. So, so yes, that's and that's on the RRG lines. That translates in both indicators to move higher at the same time. Totally right.
Mm-hmm. And I know, we've talked about this before. For me, when I look at this and the way I use it with my trading is I really like to focus on the stocks that are turning higher coming out of that weakening quadrant, because they're already on the relative strength side of 100. They're already one of the stronger relative strength stocks. And then they start to turn back up into that leading quadrant. And it's telling you at that point, not only is it one of the top relative strength, but it's also gaining momentum, relative momentum. And I think the combination can be very strong when you look at the performance on a chart.
Yeah, absolutely. What we've learned is that those rotations are very often the second lag in the up move. So the first, when you turn around, when the relative strength trend turns around, it moves from improving to leading. That can be a dangerous situation, because not all these trends, do what we expect or make it all the way through. But you're right. When a stock has made the rotation through leading, it means that it's already picked up an uptrend in relative strength. It's just going through a temporary setback, which brings it back into weakening. And when you then start to move up, you have an already established relative uptrend that's just going on a second or a third or a fourth leg higher. So these are definitely the ones that you should pay attention to.
Yeah, I think one that's on that chart that really looks interesting to me is, if you can highlight it, is the AMD. And maybe animate and let it go through its gyration for the year.
Yeah, there you go. So if you look at that, it goes in.
I mean, it just explodes.
Yeah, let me max that out and do it again. That's much better. So now you see it rotating, goes into leading, loses it. And now it's, it went into lagging, but you can see that recent rotation just is like a vertical straight up and ready to pop right over. So what I now do is I bring up my AMD chart on the right-hand side, because I like it on the RRG, and now I'm going to check whether I really like it on the price chart. Because folks, be careful, RRG is not a standalone trading system. I would highly recommend against trading only off an RRG. You always want to check your regular charts and your regular workflow. And if I look at this AMD chart, I like it because, it is very strong. It came down hard. We lost momentum. It's almost flat here. But look at this. This looks like, we found support at 16. So old resistance worked as support, worked perfectly. And it now seems to be breaking this double bottom formation. If we bring it at 22, being very conservative, it's already there. And now the aggressive version, we're already taking out 24 here. If this goes through, we can go all the way back to 34, and that will definitely help the relative strength to move higher. And we see that, despite this swing down in relative strength, this stock is still in a rhythm of higher highs and higher lows. It's still angling higher. So yeah, this would be one of my favorites inside the sector, despite the fact that it's very close to the center of the chart.
And I think if you go back to on the right-hand chart, starting in July of 2016, when that red line was way high.
Here, yeah.
At that point, I mean, the stock went up a little bit more, but you can see the stock consolidated sideways for about a year, and that sent both of those RRG lines down to the center line. And when they started to turn back up together in the second quarter of 2018, that's when we had that huge run up. 2018, a little bit even further. Julius,
right here.
Yeah,
This
right?
one here. Yeah,
yep.
This one here.
So and if you look, that's about where we are now.
That's right.
And so if we break out, and I was just looking at AMD on a daily chart and looking at about this 25 level on a daily chart, because we saw some good volume. It went up to 25. It's consolidating. I think if it breaks above 25, you're going to start to see more and more momentum and relative strength in AMD. And this could be a very important leader going forward. I think AMD, I agree with you. I think this looks positive on the chart.
Yeah, let's see what AMD does on the daily RRG. Where is it? Here. Oh, look at that. What did we just talk about?
Yep.
Inside weakening, had a good run, and it's already starting to pick up again. So, yeah, AMD definitely one to monitor closely right now. We have a few more to do, mate. So INTU is one that I highlighted. It's right here. And the reason that I highlighted it is it's inside leading. It's got a very short tail, which means that it's stable. And it's starting to point to the right-hand side. And when I brought that up, stable means horizontal, slightly higher. Look at this relative strength. That's super strong. So here we have this momentum starting to pick up again. If I look at the rotation here, let me highlight INTU for you. You see that it's stable. So the short tail means that it's stable. It still is, and it's starting to pick up right now. And this break, is important. There is no denying of that. That 230 level was important. We rounded off this corrective pattern, and we're now breaking higher. So this, together with AMD, I agree, could be one of the leading stocks in this sector.
And I do want to mention, too, Intuit reports after the bell tonight. But I think what this tells me is that, first of all, it's in that strong space in software where we've seen quite a few nice reports this quarter. And it's one of the leading stocks within software. It actually just broke out recently to a relative high versus the software index, which, as you showed earlier, has been one of the best indexes out, the best industry groups. So you have one of the best stocks. I would be shocked if they don't beat their estimates tonight. Now, that doesn't mean the stock won't pull back, but I think we're looking at some good news coming out tonight after the bell.
Yeah, I'd say as long as it holds above 230, then, all is good. If you want to be really conservative, you could even say 220, but 230 would be better. And yes, and as a matter of fact, we don't have time for that right now, but what you could do is take all the software stocks and put it against the software index. So we have software as an industry doing well against technology, and we're now looking at all these stocks against the technology sector, but we could also look at these software stocks against the software index, and then so we got a more granular view to it. Another one that it's a little bit more aggressive would be Nvidia. It's way on the left, but it's got a lot of positive relative momentum. So if we bring up Nvidia, then this is a little bit more the other way around. It's not breaking out, but it found support around 120. It came out of a relative downtrend. This is a serious down move, and it's starting to level off. So we see that RS ratio dropped, starting to curl back up. Momentum has already picked up, so that's picking up this sideways move. And this could be, you could see it as a double bottom, maybe a reverse head and shoulder pattern. I don't know. There is a bit of resistance to overcome, but this could be one for the for the early and the more aggressive players who like a gamble, pick it up against or very close to support levels. Nvidia could be one for you. Personally, I think I'd like to see a little bit more confirmation, but I know that a lot of people like to go bottom fishing and pick out stuff in the early stages of a turnaround of a trend. Then Nvidia could be one for you.
I also liked, from a fundamental perspective, the stock had gotten hit pretty hard, and then they came out with an early warning on January 28th. And when they gapped down, they actually held that prior low from December, which I thought was a positive. And then when they came out with their actual earnings a few weeks later, they beat those lowered expectations, and the stock did rally, at least initially on the open. So it's starting, I agree with you. I think Nvidia is starting to look better, but it's probably a little riskier because it hasn't shown that relative strength that we've talked about with many of the other stocks.
True. And then we're going to make this the last one, otherwise we run out of time. But Skyworks is one that's, it's also in the side improving, but you can see that it is further into the rotational pattern than Nvidia. So if you look at Skyworks here, you see that this is coming out of a very long downwinding downtrend in relative terms, and it's now starting to pick up. This one needs to probably take out 85. That's the old support level. It's now starting to act as resistance. This downtrend line has been broken. It's now consolidating a little bit. If this improvement in relative strength can continue, and the rotational pattern suggests that it's gonna, you see that this one has been, we saw the other ones rotating on the right. This one is rotating on the left-hand side. So if we play this rotation out, week, 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 every time week, and now we see it's coming closer, and we need momentum in the price chart. We need relative strength to pick up, and then Skyworks could move into the leading quadrant and move this market higher. So yeah, that's the stuff that we did. One more that I want to show you, and that's Qualcomm. And that is because I think it's very important to also know where you do not want to be. And Qualcomm is a stock where you do not want to be at the moment, because that one is inside lagging, heading lower on both axes. And if you look at, this could be a massive head and shoulders pattern with the neckline here. I don't like the position of the head and shoulders because it's not after a long trend, but it's got all the characteristics. 54 was an important support level that's broken. We're going to recover here. If this one goes below this last low, relative strength is challenging its recent lows. So by the way, this is all relative against the technology sector. Be careful with this one. There is much better stuff out there in this sector to begin with.
All right. Sounds good. Well, I want to go ahead and bring that poll up because we were giving everybody a chance to take a look at some of these stocks that I know you just covered, Julius, and get an idea of what everyone else thinks, which stocks would they consider. And I got to be honest, when I looked at this list, I would have probably, it's a little too early for me on Nvidia and Skyworks. Those were two I probably would have at the bottom. But
they're aggressive, yeah.
I like the other four, and if I had to pick one right now, I mean, Microsoft clearly has been a strong stock, but I think wanting to have maybe just a little bit of more excitement in my trade, I like AMD.
Yeah.
Yeah, I think that was my second choice as well. I'd like to see a little bit better movement, but the PMO's doing the right thing on AMD. But my favorite was definitely Microsoft. The PMO is not overbought. It just had that nice breakout from what looks like an ascending triangle. I would expect to test at least 112.50. So.
All right, Julius.
Yes. So I can circle this back to the start of my talk, because now we have a few stocks that we like in a group that we like, but how much are we going to buy? Mm-hmm. How much are we going to allocate to technology? How much are we going to allocate to software and to services? How much? So if we like Microsoft, if we like AMD, if we don't like Nvidia, but if we like INTU. This is where the money management and the portfolio construction comes in. How much are you going to allocate to the trade? How certain are you? How aggressive are you? Do you want to enter the market?
I'm going to allocate 0 to Intuit until I see their earnings report.
Yeah, that's right. That's your thing. Don't trade into earnings. Yes,
that
Mr. Bowley.
So overbought. I could never get into it. I'd hold it, but although I know you wouldn't, Tom, if earnings are coming out.
No, I would not. I love the chart. I think that, and I love the space software, and I think they're going to report really good numbers. It's a big mistake for companies not to let Wall Street know when they've got some problems coming down the road. We saw that, I think, with the stock yesterday. I think it was WIX, and the stocks continued to go lower today. You don't want to shock Wall Street. I mean, if you're trading at an all-time high or 52-week high, and then you come out and warn, that's usually not a good thing. And I do not think that's what's going to happen with Intuit. I think Intuit's going to have good numbers, but there's nothing to say that, this isn't already built in because the stock's had such a strong run. So I think there'll be good numbers, but you might still get a 20-day test even after the earnings come out. So, yeah, I don't like to hold into earnings.
Yeah. And I have to say my least favorite that I would be selling right now would be the Skyworks one. That is ugly, ugly chart for me on my timing signals. So,
hey, it's what makes a market.
yep.
All right. Well, Julius, we got to run. We're going to do the 10 in 10, but I always appreciate you coming on the show. You have such great information. I'll tell you, and you've seen it. I've been using these RRGs a lot more. I really believe that they.
I know, man.
Yeah, I mean, you can visualize what's going on in the market really well with these RRGs and trying to find, as you were saying, asset, allocations and so forth. It's not just about individual stocks. The sky is really the limit using RRG. Appreciate it.
I mean, I'm glad that after 4.5 years RRG on stock charts, you finally started using them.
Hey, do you know how long I had MACD on my charts before I switched to the PPO?
I know.
Too long?
Yeah. Well, the good news is I'm very loyal. So once I make the switch, look out. So I got your back now.
No problem. Appreciate it.
Always
welcome to the group now.
Exactly. Take care, and we're going to have you back on soon.
Absolutely. No problem. Ciao, guys. Bye-bye.
All right. Thanks, Julius. He is always fun to have on the show.
Absolutely.
And I tell you what, those who don't know Julius, if you haven't met him, some of you probably at some of the conferences maybe have met Julius. He's just like that in person. He is such a fun guy to be around.
Absolutely.
All right. Of course, everybody at Stock Charts is very fun to be around. Who am I kidding, right?
Yeah, I guess.
We're okay. Well, you're better.
We're okay. We here. We don't see each other, but we talk like practically every day. So
yeah.
All right. Well, I do have a lot of 10 in 10 requests here, and I think we should just get to it, of course. But definitely, if you added up the technology and discretionary requests, it's half. So those aggressive sectors, a lot of interest there.
All right, let's jump in because I know we're running late, so I'm going to try and do this very quickly. At our auto home, ATHM, I don't like it. Stock had a reaction high back in December. You can see where we are relative to where the market was just a couple months ago. We've seen the S&P 500 explode. This stock can't get through its January high. So not good. When you look at it on a relative chart, that's exactly what this is going to tell you. So if we were looking on an RRG chart, you would see the stock on the far left side of the page where it's been relative laggard. Occasionally, you might see the momentum pick up, but it's going to stay on the left side of that page on the RRG. I don't like it. It's got to show me some more. First thing it would have to do is clear $83 on a close. So I would say avoid for now.
All right. And the most popular in the chat room right now is Pfizer, PFE.
All right. Pfizer is part of the more defensive pharmas. I actually still like the pharmas. I think there are other stocks maybe that are performing a little better. You can see that here with the negative or with the downtrending relative strength, Pfizer versus its peers. So if I was annotating, the one thing I'd like to see maybe before I would be interested would be, can we break here? I want to see a relative break versus the peers, because otherwise I can find some other stocks. 2019 has not been kind relative to the S&P 500. And you can see part of it is just the fact that the group has not been very strong on a relative basis. So it's hard for a stock to outperform when its group is lagging. So what do you look for from a price perspective? I think it needs to clear the recent highs. If we can get back up through these tops at about 43.25, I would grow more bullish on Pfizer, especially if it began to outperform its peers and the S&P 500.
All righty. Let's look at, for our friends in Canada, this is an industrial, CCL/B.TO.
Okay, nice breakout recently. I think the pull back to the 20-day moving average is buyable. I'm a fan. So let me just draw in the support level that I would be watching. I think first of all, you had this prior top. This was just a little bit higher over here. So I'm going to say right about there. You got the breakout. We came back down. We didn't quite get the price support, but we did test that 20-day moving average with a PPO that was recently at its high when price was at its high. I would expect a bounce here. I think you're going to make another run up here for about 59.5 or 60.
All righty, next one up, Lumber Liquidators, LL.
Right, LL. Well, I don't even need to bring this up on the relative chart. This is an ugly chart. Been downtrending. Again, not above the January high, so it's still showing relative strength. The rallies have not been on very good volume. I have my doubts here. Until the stock begins to show some relative strength and can clear that initial reaction high back here in November, so I'm going to say around 1320, I think that this is one I would just stay away from. Not a fan.
All righty. How about AT&T, our only comm services request, which is T?
All right. Yeah, this is another one. I'm going to pull this up. Might be showing a little bit of relative strength recently, so let's pull this up on the relative chart. Well, not much. I mean, there's the group, and then coming down here now, it's still kind of languishing. Starting to show just a little bit of relative strength here in February, but I would have to say, again, you've got to clear some overhead resistance in addition to begin to showing some moderate or slight, actually, relative strength. I think we need to clear a couple of key levels. First one, without a doubt, I mean, you can see right there we bounced off of 31.25. We gapped down on massive volume, sold off at 31.25. We failed at 31.25. Here we went up above 31, couldn't get through, and now here we come again. Let's get through 31.25 before we even, consider getting in. So I'm not a fan. It is a nice dividend stock. I think it probably yields 5% or so, but it's not one that I would trade. I'd be looking for capital growth, and right now, not really doing a whole lot of that relative to the market.
All right. Our only consumer staple request, PYX, Pyxis International.
Yeah, this is one that really has started to strengthen here in February. So I do like that. The volume coming in, it's overbought in the near term, but I do like this volume coming in off the lows. So it's starting to show strength here. This is the tobacco index, and here is the stock relative to the tobacco index. So as long as this continues, and we're seeing this move to the upside, as long as these four lines continue moving up, then I'm fine. In fact, I would be a buyer on a pullback to the 20-day moving average. So I'm just going to highlight that quickly, which is right here. We haven't had a 20-day test yet. We probably will get one. So when we do, that's where I would be a buyer.
All right, excellent. Berry Plastics Group, BERY.
Yeah, that one I think is on my strong earnings chart list, and for some reason it's ringing a bell, probably because of the breakout. It's $51. So this is one that gapped up with earnings, then sold off, but they had strong earnings, so I did not really believe in that sell-off. I thought that things were starting to improve here, and that's what here was the volume on that the earnings report, and the stock intraday was making a breakout, and then we saw it pull back, and then made this move back to the upside. It is now clearing those highs. I think the stock goes higher. The group overall has begun to strengthen. I would like to see this relative breakout, very similar to what we looked at a couple stocks ago. But overall, the group has been doing pretty well versus the S&P, and so therefore Berry Plastics has also been doing pretty well. So if there's one negative, I would say it's this relative downtrend here versus its peers. But I'd like the breakout, and the fact that the volume's been pretty good on this move back up off the recent low, I think the stock goes higher.
All right, excellent. The next one up, Helmerich and Payne, HP, the other HP.
Yeah, I always want to say Hewlett-Packard with HP for some reason. All right, HP, I like the 20-day test. Now, this is it. It did fail pretty close to resistance, so I would want this to hold the 20-day. Now, the overall group has not been strong, but this had been a very strong performer within a weak group, a very weak group. And if you look down here at the relative strength, it has been incredibly weak for a long time. So that's the downside to playing a stock that's improving in a weak group. And what that would mean to me is watch this 20-day moving average. If it starts to roll over, I wouldn't take any chances because you know that you're in a group that has not been very strong. So watch that 20-day. And then recently we did have this breakout and we've got gap support at 54. So I'm going to say 54 up to about the current price, 55.5. That's going to be a major area of support on HP. And to be honest, I'm not even going to like it if it closes below the 20.
All right. Next one up, computer hardware, Mercury Systems, MRCY.
Love this one. Talked about it earlier. I thought it was one of the best earnings reports when it came out. We talked about this one on Market Watchers Live, and you can see the stock continuing to go up. Stock was trading at about 50 and change and gapped up to 56 and kept moving higher on one of the heaviest volume bars on the year. That tells me that there is a lot of interest in the stock. Now, I don't like today's candle, so I think we could possibly get an opportunity back down closer to $60 if it weakens. But this is a stock that you look at the group, computer hardware, and this is one I think that I know Julius and I talked about before the show. I'm not sure if we talked about it during the show. But when we look at technology, computer hardware is the one way over to the left because Apple, on a relative basis, has not been very strong. So that is taking the whole index down. But MRCY is outperforming wildly the S&P 500, even though it's in a group that is wildly underperforming the S&P 500. So pretty interesting stock. I like it, but because the group's not getting money, I think we have a shot here to get the stock back down closer to $60. So let me annotate that price support area, which is, well, there's gap support all the way down to 55. But here, I'm going to say just under 60. This is where we kind of moved up to, hesitated, and then made another breakout, and we haven't gone back down. I'm going to say $59 to $60 would be an excellent entry into MRCY.
All right. We talked Microsoft. This is another software setup, and actually I think it looks better on the RRG. Splunk, SPLK.
Yep, in addition to having just an awesome ticker and name, Splunk.
Nice pullback.
Yeah, I like this little selling here. I think this is another leader in software. I mean, there's so many software stocks that have performed well, and I honestly think this group is deserving of overweight. Until it proves that it's no longer outperforming, then I would stick with it. And Splunk is one of those individual stocks that I think looks pretty good. Let me just annotate that breakout. And that is what we're going to look for on a pullback. Right here we had tops. Over here we had tops. Pulled back, broke out. I think we could move back down to around this 130 level to test that 20-day. We haven't tested that in the past 2 months. So I think if we get back down to the 20-day, I'd be a buyer, and I'd look for a move back up to test that recent high.
Excellent. That completes the 10 and 10. Here are the symbols we just looked at. They'll be in the Market Watchers recap, or you can go to the Market Watchers live blog, and the link is right there at the top of our blog. All right, time to look at the market, what has been going on, and then we'll get into our final segment. All right, so as you can see, the market started much further down, but we have been cutting those losses. And in fact, looking at the NASDAQ, almost back to the positive side. S&P 400, the small caps, also trying to make up some of the losses earlier in the day. TSX, it is negative, but definitely close to coming up to the positive side. Treasury yields gapped up and are continuing higher, currently at 2.695%. VIX spiked up just above 15, but it is back down close to 14. UUP is making a very nice little run to the upside, up 4 cents. And gold, GLD, is falling right now today, and it is at 125.37. USO down about 0.5%, and TLT, big gap down and continuing lower very quickly, reading 120.78. And as far as our sectors go, technology, consumer staples, utilities are leading right now in the positive. Everybody else is mostly negative. All right, Tom, that's all I have.
All right, I'm going to jump into my blog article today. I did talk a little bit about the dollar, so I just wanted to point out. Now, this is, first of all, I wanted to show you a couple things here. Russell 2000 obviously has had a big move versus the S&P 500 has been outperforming. That's generally a good sign about our economy. Railroads also very strong on an absolute basis and also on a relative basis. That tends to be a good sign about our economy. And when we've got a strong economy, what tends to happen is our interest rates here in the U.S. go up faster than what we see across the pond. In this case, I'm looking at Germany. So the 10-year Treasury yield has been going up faster here than in Germany, and that generally relates and results in a rising dollar. I think the dollar continues in this uptrend. So why is that important? Well, this is what's going on over the last 8 years, the rising dollar. Here you have materials relative to the S&P going down, energy relative to the S&P going down, emerging markets relative to the S&P going down. And if you think the dollar doesn't make a difference, let's go back to the last bull market. The dollar was going down from 2002 to 2007. And when that was happening, materials led versus the S&P. Energy led versus the S&P, and emerging markets led versus the S&P. So the dollar is really important. And until that dollar shows a breakdown, my headline today was a commodity bottom. There's not one in sight. Really, what I was referring to is a relative strength of commodities, not necessarily the absolute charts, because the absolute charts, some of them are going higher. But on a relative basis, don't look for relative strength until we see a breakdown in that dollar. All right, let's move on. This is going to be our final segment today, and it's a new one. It is on the move. So, Erin, take it away. And what stocks are you finding on the move today?
You know what? What I decided to do is just go to our home page and look at the big scooter movers and also the big volume movers. And so you can do that very simply with any of your little tiles here. Move it to scooters or top 10. Let's go ahead and look at the most active right now on the New York Stock Exchange. So I have those that are most active. Obviously, they come up. It's nice. You could also do a % up or % down. But I wanted to look at what was most active. And the way I like to look is on my candle glance, because it has all of the things I want on it to tell me whether I want to have, whether I should have interest in this a stock or not. And, you know, as you can see right here, these may be the most active, but as far as my symbols and that sort of thing, of course, you also have most actives to the downside. I would be looking for, of course, rising PMOs. This one, the PMO is now getting positive, just had a positive crossover for Encana. So that could be an interesting one to look at. You can see a big breakout here on Kinross Gold, but having a big pullback today. And I noticed with a lot of the gold mining stocks, we're seeing a lot of pullbacks with gold miners moving back quite a bit. In fact, let's go ahead and we'll just look at a few that just look at the Vectors gold miners, and you can see down almost, well over 1%, 1.11%. We're coming back though to some interesting support on these miners, and we're still seeing rising bottoms on the PMO. So I'm not going to give up on the miners just yet. You have this really pretty flag that executed nicely. We should expect a higher move than what we got here. I think it's just a natural pullback on a pretty nice run to the upside. And of course, the gold miners are affected by gold. So, you know, what are you going to do when gold's taking a hit of almost 1%? That's going to affect the miners. But a lot of people say, oh, well, you know, gold's up. Why are the miners down? You know, because they don't always follow each other. Well, you know, the miners trade, you know, they're companies. They trade differently. The gold GLD is just based, of course, on the price of gold. And so things happen in a company that makes, you know, that will make your stock go up and down that doesn't really have anything to do with gold's price. So they are tied, but not completely. And I know another one that's having a not good day because I own it is Barrick Gold. Really, I made all of this money on the upside here, and I'm pulling back 3% of it right now. So not liking that. However, if I look at my PMO, you know, I got the bottom above the signal line. It's certainly not overbought. You know, we got a higher top on the PMO. So at this point, to me, it's a hold. Also look at what's going on with the OBV. So nice volume here coming in. So stocks on the move, I would have to say I concentrated more on gold miners and, you know, gold itself. A lot of the reason being that, as I said, I've been looking at my own portfolio today, and these were the big losers right now is gold. Of course, the other defensive sectors I think are looking a lot better. I was pretty happy because if you look over here at our sector summary that I had up earlier, you can see as far as sectors go, staples, utilities, and discretionary in the top 4. And right now I'm holding these 3. So I'm feeling pretty good in that defensive sectors there of utilities and staples. But I put my toe in the water with consumer discretionary. So those were ones that I had on the move. I thought I would leave you some extra time, but the main thing is, guys, you can go right to the dashboard and pick. You want scooter movers? Do you want it on large caps, small caps? And then, like I said, I scroll down and I use my candle glance that I have set up the way I want it. And if you want to set up your own candle glance, all you do is set up your chart style that you want for your candle glance, and you just name it candle glance. So you set it up the way you like it, like I just did with my PMO and my EMAs, and now that's how it comes up. So I can see those stocks on the move very quickly with all of the things that I look at for a decision point.
All right, sounds good. I'm going to jump in. We got a few stocks here I want to take a look at. These are all on the move, and the reason I know they're on the move is that they're setting new 52-week highs. So they got to be on the move.
Right.
Here, MDLZ, Mondelez. This is a food products company. Huge move to the upside. This is clearly in that consumer staples area, so more defensive. But look at the huge candle here with the heavy volume back at the end of January. We've just continued moving, definitely on the move. And when you look at this relative to its peers and relative to the S&P, very, very strong relative price action, despite a group that has been lagging the S&P for the last 3 or 4 months. So definitely MDLZ has been on the move. Let's move on to T-Mobile. This was my pick for this week. It continues to be on the move. Did make a breakout. I really like T-Mobile. I think this sideways consolidation for a while is good. Anytime you have a lengthy basing period, I think when you get a breakout, that's good news. Here we've got the breakout. It's continued moving higher. I do own T-Mobile, and I also like the mobile telecommunications group. And you can see that this is a group that is starting to strengthen again here in February, which I think is a good thing. T-Mobile relative to the group has been very strong the past 2 or 3 months, and you can see clearly it has been a leader relative to the S&P. And now this is what I was referring to, starting to see strength coming back into the mobile telecommunications. If I was looking at this on an RRG chart, I believe what you would see is that we would probably still be on the right side of the chart, maybe just a little on the left, but we would beginning to see that huge momentum push back to the upside based on what's happening here in February. So I think the group is just beginning to strengthen, and here's one of your leaders. So T-Mobile definitely on the move. LSCC, let's move into the semiconductors. And this is Lattice Semiconductor. Julius talked earlier about the semiconductors being strong. This is one of the strongest stocks. Look at the massive volume that came in with the earnings. Continues to move up. I'm waiting on a pullback. I love this stock. It's on my strong earnings chart list, but I need to see a pullback in the stock. It would be great to get it back down 9.5. I don't know if we'll see that, but somewhere down the road, as the 20-day rises, we'll probably pull back and hit that 20 for a possible trade. ACIA, this is Acacia Communications, another one. Now look at the telecommunications group. This is another area that's been very strong relative to the S&P, which enables ACIA to be a very strong performer. It is just making a relative breakout to the S&P 500, and it's also been one of the stronger stocks within the telecommunications group. Here is your price breakout. Now, let's see how this thing finishes. It's got increasing volume today, and if it leaves that long tail up there and goes negative today, then I'm going to think probably a short-term top is in. I'd wait, maybe get it on a rising 20-day moving average test, but I believe we're setting up here for a breakout on ACIA. FLDM, when I did my top 10 picks over at Earnings Beats the other night, this was one of my top 10. I love this stock. Love the breakout here. It's in the medical equipment space, which also has been very strong relative to the S&P 500. Everything on this chart to me looks good, including volume trends, and it just continues to power forward. Sleep Number, SNBR. Not only do they have good sleeping products, but the stock also is very good as well. Beautiful breakout above the prior high in November. Volume coming in to support that move. And within the furnishing space, it has been one of the best stocks. now that and that's led obviously to a lot of outperformance versus the S&P. And furnishings actually has been uptrending now for the last 3 or 4 months. So this is a group that's on the improve, even though it was horrible in 2018. So far in 2019, it's been a leading group. As long as this keeps pointing up and we got this stock continuing to perform well with the breakout, I'd say a pullback to test gap support or that rising 20-day would be interesting. Last one I have is FLNT, just making a breakout here today. Actually broke out yesterday, so continuing that today. Volume, I look down there, and some days maybe it's kind of so-so for me. I like to have an average of at least 200,000 shares. It probably does average that. But within the media agency space, you can see the group hasn't broken out, but Fluent has. FLNT, I like the breakout. I think this is another one on the move. So those are the stocks that Erin and I covered for On the Move. Give you a quick recap of some of the stocks and areas of the market that we took a look at. And we are toward the end of another show here, Erin.
Oh my gosh. It goes fast when Julius is here because what he talked, the RRGs are so fascinating. I'll never forget when I saw it for the first time at one of the chart cons. I think it was 2016. No, probably 2014. Yeah, 2014.
Well, I think too, sometimes when you're looking at the RRG, it took me a while for my eyes to adjust to what it was telling me. I had to kind of, because I always like to use the colon. So for instance, I would use something like, let's just say, a good stock over the past several months has been Twilio. And so I will show you a chart here in 1 second. And, I always look at something on a relative basis as something colon, another symbol. So if I wanted to look at, for instance, Twilio versus the S&P 500, then I would take Twilio, put the colon in, and type in the S&P 500. Now, when I do that, I like to use solid line charts. But here is an updated chart. If I can pull this up, bear with me.
Yes. I mean, yeah, the RRG. There you go. We got it.
Yeah, I mean, this is what I was used to seeing before I got used to the RRG. And I used the analogy earlier. It's kind of like me with the MACD versus the PPO. It just took me a while to get used to it. Now, when I'm looking at, say, Twilio, or I'm looking at any stock versus the S&P or versus their index, I pretty much know that I'm going to have a relative strength. I'm going to be on the right side of the chart on the RRG because I'm showing relative strength. And the amount, the significance of the move to the upside is going to direct that relative momentum. And so I can kind of look at this chart now, and I already know the way it's going to look on an RRG chart. And I think that's true of anything, any change you make. Once you look at it for a while, it's going to fit your eye a lot better. And I just think that's important.
Yes, absolutely. Yeah, I love the visual. Of course, we all do. That's why we do what we do with charts.
Yep. And I do completely agree with Julius, by the way, that I would not buy a stock simply based on the RRG. I think you still have to go to the actual chart.
Oh, yeah, exactly.
To do that. Well, there's your update. I just updated for everybody. The Dow Jones, you can see down 77. So it's been down all day, started to strengthen. Now it's weakening a bit. But one thing, volatility just seems to be gone. I mean, now a 40-point move seems kind of big. But
true.
Anyhow, all right. I want to thank everybody for being with us today. Again, special shout out to Julius de Kempenaer for joining us. Always a pleasure to have him on the show. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here tomorrow. Happy trading.